Yep. So once again, this is financial accounting and we're doing chapter 12, which is equities. Okay, so we've crossed from the assets and liabilities. We're still on the same side of the T account though. Just like liabilities, equities have credit balances. Okay. Let me repeat just a moment here what we're talking about. Equities are usually divided into two kinds. There's the paid-in capital, which is selling shares of stock to raise capital in your business. If you go public and sell shares of stock, then you're going to have to be okay with the risk that you're going to have to work with other people that might buy up quite a few of your shares. The other part of stockholders' equity is something called retained earnings. Now, I think you have been acquainted with retained earnings because that's where net income or net loss or dividends get pulled out of retained earnings, okay? So classes of stock, we're going to have common stock and we're going to have preferred stock. With each class of stock that we have, we also have an account that goes hand in hand with it. If we sell our stock for more than its par, okay, you say, well, what's par? I know about par from playing golf. Well, par is how many normal golf strokes it takes usually to get in the ball in the hole, right? Well, par for stocks is just like the face of a bond. It's just the amount, it's the value, and only accountants use the par value of stock. Nobody else does, okay? Nobody else cares, but accountants do because they want to keep track of how many shares of stock are out there. And there's really no way to keep track of it without keeping the par of the stock. Now, if we get paid more than the par, hey, we're going to take it because we're trying to raise capital here. When you're trying to raise capital, you'll take as much money as somebody's willing to pay you, right? So once again, these go together, just like this preferred stock account goes with this preferred stock account. If we pay dividends, dividends are earnings of the company that are being sent to the shareholders. Shareholders, this is not required by law, but remember, it's the shareholders that you built your business on their investments, right? So if you are building your business and you're running your business to benefit investors, then you want to do the best you can with, and make sure to send them earnings when it's possible, okay? Sometimes it's not possible. You can send cash dividends to owners, and you can also send stock dividends. Cash is cash, but you got to have the cash to send. And if you can't afford to pay cash, you may consider sending stock dividends, okay? If you send stock dividends, that's additional stock on top of what they already own. So it's more shares of your business, but everybody who owns shares of stock is going to get the same dividends, okay? Except if it's preferred stock gets in line for the dividends first. And I was showing this little picture from the book. This is showing the two classes of stockholders here. So if they decide to distribute dividends, right? Got to have the money to be able to distribute it. But if the money is determined there, if it's available, then they'll send out the dividends. If preferred, and it depends on each preferred share of stock may have a different feature to it. Okay, so there are features to stock that make them more valuable than others. All right, so let's go ahead and I've got some examples here of the things that are going on. All right, and let's see if we can't take care of this. All right, so the Zero Calories Company has 30,000 shares of cumulative preferred 3% stock. You say, what does all that mean? Well, it means, first of all, they have two classes of stock, right? So before we get all worried about what all that means, let's just put down how many preferred shares they have. They have 30,000 preferred shares of stock that are out there. They're in the hands of the shareholders, right? That's often called outstanding, shares outstanding. Their common stock, they've got 300,000 shares. Okay, so you might write down what your problem is telling you. Okay, this cumulative, so when you read information about preferred stock, okay, let's start with the 3%. The 3%, oh no, let's start with the par. Remember I said the amount of par really doesn't mean anything to anybody but accountants. Whatever we sell, so we're going to sell this preferred stock, right? When we sold it, its par was $50. I don't know if it sold at par, it doesn't matter. It could sell for more than par, all right? But the 3% part is telling you how much of a dividend they're supposed to get. It's the 3% times the par value of the stock. So here's what we've got. And I've got this in kind of a little area here. So let me make it bigger so you can see it better. So our preferred stock is here under this area, these two columns, and our common stock is under these two. Once again, the preference is the preference to dividends. Okay, and preferred shares tend to have a higher stock price. They're usually more valuable and more sought after by an investor. A business does not have to have both of these, but most corporations, all corporations have shares of stock. They may not be public, they might be held privately, okay? But the shares that are outstanding are always going to be at least common stock. All right, so let's put the par value of each of the stocks. So the par value of the preferred shares is 50. The par value of the common shares is 20. So kind of like we put down the characteristics of the bonds, you really ought to put down the characteristics of your stock, okay? Now over here in yellow, we've got 3% dividend, okay? A 3% dividend, that's what that 3% stands for. Okay, what does that mean? We're going to take 3% times par, right? So 3% times par. So we're going to take $50 times 0.3. Okay. And when we do that, we get a dividend of $1.50. Everybody with me? $1.50 is how much of a dividend that each share of stock is supposed to get. Now, the fact that this says cumulative, that's a feature that's even more sought after in preferred shares. What this means is that every year, these shares of stock are supposed to get a guaranteed dividend. It's guaranteed because of this word cumulative. So what's going to happen is every year they're going to pay $1.50 to each shareholder. And if they don't, it accumulates until they do pay it to them. So sometimes if a company has preferred shares that have a cumulative characteristic, then and they don't pay enough or don't pay any dividends, then preferred gets back paid their dividends first before common will get any. So I'm going to explain to you how this would work. So let's see, how many shares of stock do we have? We have 30,000 shares, right? Yep, 30,000 shares of preferred stock. They're paying out $1.50 in dividends. So every year, this company has agreed to guarantee, right? Guarantee $1.50 in dividends to every shareholder. So that calculates to a guaranteed annual dividend to preferred only of 45 grand. Is everybody with me? Okay, how'd I get there? Right? If that cumulative wasn't there, we wouldn't be worrying about paying them or back paying them, right? We would not worry about back paying them, but we have to worry about back paying them because it's got the cumulative feature. And once again, when you see the percentage of preferred, that's the dividend amount times the par. That's how much dividends they're supposed to get per share. All right. So let's see what we can do here. Okay. Here is the amounts that this company is deciding to distribute as dividends to their shareholders, right? So I'm going to put down how much is going out in year one. Okay, year one is $90,000. Okay, $90,000. Well, that's enough to pay that is enough to pay out the 45,000, right? Well, sure. All right, so if we take the 90,000 and divide by 30,000, okay, this first year they're paying out enough to cover the $45,000 guarantee. All right, so what's going to happen here is they're going to pay out the 150 to each shareholder. So what this means is so $1.50 is going to go out to each preferred share in year one. Okay, so go ahead and put $1.50 there. All right, and we're going to subtract the amount that's going out to the preferred, and there's going to be some left over to go out to common. Okay, so let's see if we can't do it. So they're sending out 90,000 and then 36,000 and then 100. Okay, so let's go ahead and put, hang on just a second. We put the 90 here. They're sending out 90 in total. So they'll be able to meet their obligation of the 45,000 there. So that's going to go to the preferred shares. So let me take some of this out. The second year, they're paying out 36,000. Okay. And then the third year, they're paying out 135,000. Okay, so let me put this down. So once again, the first year, they were able to pay the whole 45,000, and then they had some left over for common. Okay, so now common has 300,000 and their par is 20. Okay, so let me take this out. So when the $45 goes out to the preferred shares, then $1.50 is going out to each of the 30,000 shareholders. Okay, so there's the $1.50. But they now have $45,000 left over to go out to the common. Okay, so if there's $45,000, right? 45 and 45 is 90, right? There's the total right there. So they've had enough to pay the guaranteed dividends to the preferred, and then there was 45,000 left over. And when you take 45,000 divided by 300,000 shares, woo, you're paying them out 15 cents a share. You say, whoop-dee-doo, who wants 15 cents? Well, 15 cents depends on how many shares you have. Okay, I'm going to try this, make sure I'm on the right track. I believe I am, but you never know. Okay, you never know. So the good news is the first year, there was no back pay that we needed to make to the preferred. They distributed a dividend that took care of all of the preferred and had some left over for the common. The second year, that's not going to be the case. The second year didn't meet the $45,000 guarantee, right? Nope. So all of this is going to go out to preferred, and common isn't going to get anything. So we're going to take the whole amount, the 36,000. We're going to divide it by the 30,000 preferred shares. So at least $1.20 is going to go out to the preferred shareholders. It's better than nothing, right? Better than nothing. It was almost the full amount, but not quite. So here's what we need to say. Didn't pay the 45,000. Okay, we didn't pay the 45,000. We paid 36,000. Okay, so we kind of want to keep track of that. And then we owe them, what's the difference between 45 and 36? I believe it's 9,000. So, and if you want to make sure, I need to make sure because my brain is working very well. So I want to make sure. So we have some preferred stock arrears. Arrears means that we still owe them from the previous year, and we've got to back pay them if we send out any the upcoming year. So how much did we miss, right? So the amount is the 45,000 that we promised minus what we did send out, and we owe them another 9,000. Everybody understand that? That's the back pay. It's called arrears. So if preferred shares don't get all their guaranteed dividends, it accumulates and gets paid out before anything gets paid out for the next year. Now the next year, so here's what's going to happen. $1.20 is going to go out to preferred, and there wasn't enough left over at all to pay out to common. Okay, now it's year 3. Okay, now it's year 3. They're paying out 135,000. Okay, we need to back pay the preferred shares, their 9,000 from the year before. We've got an obligation then to pay them another 45,000 for year 3. So the first 54,000 of the 135,000 that's going out is all going out to preferred. Okay, so here's how much is going out to preferred, 54,000 in total. When you divide 54,000 by the number of shares, which is 30,000, $1.80 is going out to the preferred shareholders. So we're making up that 30 cents, right? We should have paid them $1.50 last year, but we only paid them $1.20. So we got to put that 30 cents in plus their $1.50. So the most they can get, the most that they'll get is what's in arrears plus what the current guaranteed dividend is. Now, when we're finished paying the 54, then we've got, hang on a minute, let's see how much we have left over for the common. Okay, the common. So once again, we're paying out 135,000. We're going to subtract the 54,000. we've got 81,000 to send out to 300,000 shares of common stock. When you take 81,000 and divide by 300,000 shares, you're gonna send out a dividend of 27 cents a share. Okay, 27 cents a share. Okay, now, if you need any help, please ask, because I'll be happy to try to help you understand what's going on. Okay, once again, you have to calculate, first of all, how many shares are in each class of stock? What is their par value? What's the percentage that goes with when they talk about the preferred? That's the dividend times the par. 3% times 50 gave us the $1.50 in dividends, and it's guaranteed because it has a cumulative characteristic, which some preferred shares don't have that. So we wouldn't have to worry about back paying dividends if that characteristic didn't exist. The first year we met the $45,000 obligated dividend to preferred, no problem. We sent out the $1.50 and we sent 15 cents to each common shareholder. But year two is where we started to have a little bit of troubles. We were only able to pay out 36,000 instead of the 45,000. So we did pay out all of that to just the preferred, with none left over to common stock. So then finally, the next year, we still owe the preferred shareholders from year two. We've got to back pay that in year three. So here is year three's dividend going out to preferred. There is the guaranteed dividend, and when we add those together, 54,000 is going out to the 30,000 shares at $1.80 a share. Now, year four, we don't know what that's going to be, but there's nothing left over in arrears for preferred. So as long as they pay out more than at least 45,000, right? 45,000 really needs to be the goal, at least, to pay out every year, so that $1.50 goes out to the preferred shareholder. Okay, I hope this is a little bit understandable. I know this can get kind of complicated. All right, let's move on to number two. Okay, we're going to start learning how to do a journal entry when you issue stock. Now, we issued bonds. Well, issue means the same thing for stock. When you issue stock, you're selling it. You're selling to an investor a part of your company, right? So you can raise capital and hopefully grow your business so that your investor then gets a return on their investment. So on January 22nd, this corporation issued for cash 125,000 shares. Okay. So once again, issue means to sell, of no par common stock at 12. All right. So I'm going to put this information down. Okay. How many shares of stock did we sell? 125,000. They are $12 a share. Preferred on February, and that happened on January 2nd. So we're going to make an entry here. Then on February 14th, we issued at par value 45,000 shares, right? 45,000 shares at par of $40 a share. So preferreds, what is this? I don't know what that is. I guess that's gotta. All right, so we issued the preferred stock at par, okay, I don't want to, let me get rid of this, just a second here. No, okay. Well, let me go get rid of this. What is going on here? There is a link in here that I want to get rid of. So let me see. Usually you insert a link. Let's remove a link. Let me see if it would let me remove that link. Should be. I don't know how that got in there. Cancel. Place in this document. I'm going to put it beside there. Okay, it's all right. So here's what we're going to do. We're going to issue that at par, right? So its par is $40. Okay, its par is at $40. The dividend for that preferred shares is 2%, but we got to take it times its par of 40, not 50. Okay, so there are 45,000 shares of preferred stock. Okay, and 2% times $40 par. Okay, so we'll come up with that here in a minute. So once again, they're paying out dividends of 2% of the par. So we're just trying to understand. And the first time we did preferred shares, we did it for par. All right. So how much went out? How much cash is coming in? Let's go ahead and do the common stock. Okay. So we issued 125,000 shares at 12. Okay. So let me see if over here is my calculations. I figured as much. So what we're going to do is take 125,000 shares at a par of 12. So 1,500,000 in cash just came in from selling. Okay, so we're going to put 1,500,000 in common stock. Okay, there is no par. Okay, so there is no excess of it. There is no excess of it. The cash that came in from the sale is 1,500,000. Okay, so that is going to be the first entry to sell those common stock that had no par at all, but we sold them for $12 a piece. And once again, 12 times 125,000 shares is cash of 1,500,000. Okay, 1,500,000. So we're going to put cash coming in for selling that stock of 1,500,000, and we're going to put it in common stock. 1,500,000. Okay. So the next entry, you can check it if you want. The next entry involves the preferred shares. Once again, we are selling 45,000 shares of preferred stock at its par. Okay, so par is $40. So I'm going to go over here and do the calculation here. So this is going to be 45,000 shares at a par of $40 each. So that second entry raised 100. Let me just get rid of this. Okay, that second sale of stock was for preferred. So we're going to make cash go up, and we're going to make preferred stock go up. And I believe it's going to be $1,800,000. Okay, because that's the 45,000 shares times its par of 40. Okay, let's check it. So let me show you how this is going to work in the T account. Okay, so one more time, this common stock has no par. Okay, so I would have listed the par up there if it would have had one. This preferred stock has $40 of par. Okay, $40 par value. We sold 45,000 shares. I like to keep track. So then preferred shares ended up having 1,800,000 in it. Okay, cash came in for 1,800,000. And those were the first two shares of stock or issuing stock, both common and preferred. How much did we raise? Wow. We raised 1 million, 2 million, 3 million, and $3,300,000, I think, by selling these two shares of stock. Right now it's August 30th. The company is now issuing for cash. So cash again. Okay, so each of these is a different timeline. So that first one was January 22nd. Okay, that second one was February 14th. And this third one then is August 30th. Okay, so I want to try to make sure to keep track of the dates. So we are issuing for that third stock sale 27,000 shares. We're selling them at $42 a share. Be careful, this is above par. Okay, $42 each. So I'm going to put $42. So I'm going to take 27,000 shares times $42 a piece. This is how much cash we brought in. 27,000 times $42. Okay, we're bringing in cash of 1,134,000. Okay, when cash comes in, then we want to be careful now. Be careful. We cannot put stock in here for anything more than the $40. So we've got to figure out how much. So once again, $40 is the par. What is 40,000? What is $40 times 27,000? Let's calculate that. 27,000 shares at the par value is 1 million. Okay, let's put this in. $1,080,000 in the preferred stock account. Now be careful. This number and this number do not balance. Okay. The stock sold at $2 over par. $2 over par. Okay, so $2 times the $27,000 is the excess we received. So one more time, 27,000 times 2, that's above the par. This is the excess. We have an excess of $54. We're going to put that excess over here. Okay, the excess is 54,000. So now let's see if we can put this in. Woo, we calculated the cash at 1,134,000 for selling preferred stock above its par. Okay, and then when we record the preferred stock, we can only use par in the preferred stock account. Okay, we can only use par in the preferred stock account. So we're going to put 1,080,000 here, and then the rest is excess above par. Excess above par, and this was for preferred, right? So our excess was $2 when we sold 27,000 shares, right? So an extra 54,000 is going to be put in the capital, paid in capital in excess of par. There it is. So there's how it goes. If you, once again, if you sell a stock for anything above its par, you've got to move that amount or use that amount in the account called paid in capital in excess of par. Now, here's why we do this as accountants. Is everybody ready? I'm going to add up how much we have in our preferred account, right? I'm just going to add it up because we had 2 sales of preferred stock. We've got 2,880,000 in there. We sold 45 and then we sold 27,000 shares. So the total amount of shares for both of those is how many? 72,000 shares are sitting here but you could figure that out if you wanted to. If you wouldn't have kept track, you can always divide the total dollar value in preferred stock by its par, right? So if I take the total in preferred stock and divide by $40, oh, there's the 72,000 shares. So we can always keep track of how many shares we have sold by always using par when it goes in the preferred stock account. Okay, so it is important to know that. Okay, that first sale, we didn't sell it for more than the par. We sold it for exactly the par. Okay, all right, let's keep going. Number 3. Okay, here comes cash dividends. Cash dividends. All right, so let's see what's going on here. Down here to number 3. Number 3, cash dividends. Okay, when a business decides to share dividends with shareholders, there are 3 dates that we have to do something for. All right, so it looks like that they're planning to pay out a cash dividend of $455,000. So write that number down. That's the amount they've determined they can afford to send out. Okay, when they decide, there are 3 dates. And notice we've got October 1, November 7th, and December 15th. Paying out dividends can take a little time because we have to figure out who owns those shares so we can send them the dividends. The other thing that happens is if the stock market hears that shares are going to be getting dividends, then all of a sudden their stock is more in demand. Okay, so the first thing we're going to do is declare a dividend. Declare a dividend. So how you do that is there is a cash dividend account that's an equity account. It's not cash. It's not cash, the asset. It's cash dividends, the equity account. We're going to put that amount as a debit to that account, and then we're going to put it in a cash dividends payable. Okay, so we're doing this entry here on the date that they're declaring the dividend. So this is the dividend declaration, or the date of declare. So they're going to declare, declare sounds like a weird word. Well, I declare. Well, that sounds like something from the South, right? Well, when you declare, you're making a promise, right? So when you declare, they're going to declare $455,000 dividends will get paid out soon, right? So that's going to be the date of declaration, is putting down how much that's going to go out. And then we're going to put that in a payable, so it's ready to go when we're ready to pay it out. Okay, now the next date is November 7th. This is called the date of record. The date of record. There is no entry on the date of record. The date of record is just for the shareholders to get their mailing information so we can send out the dividend checks to them. So there's no entry here. It's just a date that, once again, shareholders have a deadline. Shareholders have a deadline to send in their name and address so that we can send out dividend checks. Okay, so let's go ahead and check our work through here. And then finally, on December 15th, right before Christmas, they're going to send those dividend checks. So when we send a dividend check, we're going to debit the payable because we're finally paying that out. And we're going to credit cash because they are cash dividends. So a debit to that dividend payable to send it out. And we're going to cut a check from the cash account for all of those dividends. So the shareholders receive them. So it took what? A month and a half, 2 months and a half, pretty much. 2.5 months to say, here's our dividends. And then here's when we're going to send them out. Okay. So please kind of get the idea that there are 3 important dates when it comes to shareholders. 3 important dates: date of declaration, date of record, and the payment date. Okay, and I have this in a little picture up here somewhere. There it is. Okay, so when dividends are declared, okay, no, this is the stock dividend we're doing. Okay, that's fine. Okay, we are going to do a stock dividend, so hang on to your socks. Okay, this can get a little weird, but we've got a picture of how this works. We've got a process to look at, so we may hopefully not get so confused. So if you don't have cash to pay out, what would be another thing that you could pay out to shareholders to maybe make them happy for a little while? Okay, so here's an example. And we'll look at this if we need to. I'll bring this down here, I think. Let me go out here to the side. And I can bring it down here next to where we're working on this. So we're going to send out stock dividends. So this is problem 4, or exercise 4. Stock dividends to common stockholders. All right, so let me go copy this. And in case, because I don't do this every day myself, sometimes I have to review it. So I'm going to copy this picture and bring it down here to where we're going to be figuring this. Okay, so that we have it to look at. So it's the 4th exercise. Okay. And then we're going to put some information in here. So let me put this down here. Okay. First thing we need to know before this stock dividend gets started is, what are they declaring? Okay, they're going to declare a 2% stock dividend. Let's write that down. They're declaring a 2% stock dividend. How many shares do they have outstanding for common stock, right? So common stock has, I'm just going to put it down here, according to my problem, 29,000 shares outstanding. You might put next to that, if you're writing it down, what that stands for. Okay. Shares outstanding. Shares outstanding are in the hands of investors. Okay, so we've got 29,000 shares. Those shares have a $50 par. Okay, you got to write that down. So those shares have a $50 par. Okay, we're declaring a 2% stock dividend. So what you do to figure out how many shares you're going to send out, you have to take your shares outstanding times 2%. So however many shares your problem says, mine is 29,000 shares. I'm going to take 29,000 shares times 2% to see how many extra shares I'm gonna be sending out. Okay, so, where am I? The additional shares, okay, additional shares. 29,000 shares times 2%. So is that right? Let me see. Okay. 2%, 29,000. Let me make sure my calculations are correct here. 29,000 shares times 0.02. Okay. Yes, thank you. All right. So we're sending out 580 shares. They have a par value of 50, right? Par value of 50. But now we got to pay attention to the stock price. Okay. It's the stock price that matters for this part. So right now, our shares are selling at $66 a share. So we really want to take that times $66. $66. So the stock dividend has a value, right? If we're sending out 580 additional shares and their value is $66 on the market, then that's how it's going to get calculated. So I'm going to put that here. Okay. And then now I'm going to make this calculation. It's 580 times $66. So we're going to have an additional stock value sent out to the shareholders of $38,280. So we need to know what that value is. So if you can find your value, it would be good. Okay, so once again, however many shares outstanding, we're sending out 2% more additional shares. We got to know how many shares that is, and then we got to know its market value. And then the market value is times the number of additional shares that we're sending out. So the value of this stock dividend is, for me, $38,280. Okay, so here's what we're going to do. Okay, we are going to put in an amount for the value of the stock. Okay, so let me just look at my little sheet here one more time. Okay, so declared a cash dividend and a stock dividend. Okay, so the stock dividend. 3,000, we're sending out 560 shares. Okay, let's be careful here. 580 shares at a market price of 66. So our stock dividend should be 38,280. Okay, that we're sending out in value. So we're going to put that in a stock dividend account. The stock dividend distributable, let me look at my notes here. I think I got some notes to help me because I don't do this every day myself. Okay, so the par, by the way, is $50. Okay, so stock dividends, 38,280. Stock dividends distributable should be okay, 38,280. Okay, hang on just a minute. Okay, what does it tell me? Stock dividend of 72,000. So this is going out to, hang on, this is going out stock dividend of, okay. Okay, the number of shares, additional shares that we're sending out is the 2% times the number of shares that exist or that are out in the hands. So we got 580 shares. And I'm trying to remember what I did here. All right, so we're going to send that out. Okay, so let me let me look at my little picture here. I knew I put this picture on here for some reason. So the stock dividends is the total amount going out, right? Yes. All right. Okay, so what's gonna happen is the par of the stock that we're sending out is $50. Okay, so I think I remember how this goes now. All right, so we're gonna take 580 shares times 50. Okay, because we're going to make this a distributable amount. Okay, but we can only go up to the par. So 580 times 50 is going to be $29,000. So let's go ahead. Let's put the stock dividends as the whole amount. Okay, the whole amount of the dividend that we found up here. The stock dividend value goes in stock dividends. Let's key that in, 38,280. And then part of the rest, we got two credits. So we're doing 29,000 because that's the additional shares times its par. Okay, additional shares times its par is 29,000. Okay, so that is going to go in dividends distributable, and the extra, okay, and once again, that par is $50. Okay, and the extra shares are 580 for my problem. So the extra price, so remember the market price, right? The market price for me is $66. That's $16 more. So the rest has to come out of here. So we're going to take the stock dividend value and subtract the stock dividends distributable, and the excess is the 9,280. So this is going to be in excess of par common stock. Okay, in excess of par common stock. I think this is one of the most difficult entries you can make. All right, so we're declaring it based on the percentage times the number of shares out there, because we don't want anybody who already is a shareholder to lose ground with how much they own, right? We just want to give them some more. All right, so we've got this in here ready to go. Okay, so let me, all right, so then the next one, okay, the next entry is going to be to send out the shares. And now we're not sending out any cash. We're sending out the number of shares. So they already have 29,000. We could find the balance in common stock, right? Because they have 29,000 shares at $50 par. That's the balance. I'm going to calculate that. Equals 29,000 shares times 50. Okay, so they've already got a balance of 1,450,000 in their common stock. Okay, we'll see ya. Bye. Glad you could come in. I know this gets pretty complicated. All right, so then those additional shares, okay, the additional shares are going to add 580 times, right, times that 50. So common stock, we're going to show that amount, which was the 38,280. So we're going to put that in common stock. 38,280. Oh, no. This is date of record. Sorry about that. The middle one is always the date of record. So this is paying them down here. So date of record does not require an entry. We just need to know who we're going to be paying the shares to. Okay, so luckily that middle one is kind of done. All right, so when we get rid of, right, or not get rid of, when we pay out the dividends, we should be paying out the 580 times 50. So that should be $29,000 extra in common stock. So they now have 29,580 shares outstanding, because the 580 was the extra that we sent out. So let's see. All right, so the distributable becomes 29,000. All right, and then, so let me see what my picture shows over here. Let me see if I'm right. Hey, well, that's good. And there's 0, 0 there. Okay, and let me see, stock dividends distributable. Yeah, so while we're increasing stock, we want that debit to be here because we're getting it out of here, right? A stock dividends distributable is pretty much a liability that says we will be paying this out. So here is the debit, and it's going to go to stock dividends distributable. Okay, stock dividends distributable. All right. I think we made it. Maybe. I'm not going to test you on this, by the way. I think it's a little too complicated. We got enough. All right, let's go to the next one. How much time? Okay, let's see if we can knock this out. So number 5 is called treasury stock. Well, here's the idea with treasury stock. When a company sells stock for the very first time, it's called an IPO. It's called an initial public offering. That's called the primary market. So when they send out the shares and sell them for the very first time, that's the only time that company is going to make money, okay, make capital. But they want to participate in the secondary market just like any other investor. So treasury stock is called reacquired stock. The company is actually going out and buying their own shares of stock in the secondary investor market. You go, what? How's that legal? They're just like any other investor. They're buying the shares at the market price and they bring them into their company. And when they bring them in, it goes in an account called treasury stock. Why do we buy shares of stock? We buy them low, so hopefully soon they will have a higher value, right? So let's get started. Okay, let's get started. Treasury stock is what we're getting ready to do. I don't think this is as hard. That stock dividend can be a pain in the rear. Once again, we're going to be our own investor. We're going to buy shares of ourselves. Okay, but when we do that, we have to disclose it and we have to pay attention. So let's reacquire. Let's buy some of our own shares. How many are we going to buy? We're going to buy 75,000 shares. So you're going to have to figure out how many shares you're buying, just like any other investor would. And what is the price that we're paying? For our own common stock, we're paying $8 a share. Okay, let's calculate 75,000 times 8. How much money are we paying to buy back 75,000 of our shares, right? So I'm going to do the math here. So 75,000 times 8, $600,000 is how much in cash we are spending, right? So here's what we're doing. We're going to put 600,000 in treasury stock. Treasury stock is an equity account. Okay, it's an equity account and it has a debit normal balance, which is odd. Okay, it's odd. We also have an account called paid in capital from sale of treasury stock. Now, when we put this treasury stock in here, we can only use its cost. So the cost is actually the 600,000 shares. I'm sorry, 75,000 shares. We'll see ya. Thanks for coming in. The 75,000 shares at 8. All right, so let's put 75,000 shares. All right, and that's what this $600,000 represents. And down goes cash. Okay, so down goes cash. So that's our first entry. We bought the treasury stock. We're putting it in an equity account that has a weird debit balance. Okay, a weird debit balance. Okay, so what do we hope? We hope that these shares that we just bought with $600,000 cash, we hope that their value goes up, right? So this happened on May 27th. Now we're ready. On August 3rd, we sold 54,000 of those shares for how much a share? $11 a share. We bought them for $8. We're selling them for $11. We're going to make a little $3 extra money, right? A little $3 extra money. So let's go. So now we're going to sell 54,000 shares, right? At 12 or at $11 a share. Okay, so we want to do the math there. So we're looking at $54, 54,000 at 11. Okay, we have a certain amount of that, and then we're actually going to record the shares coming out of the treasury stock account at the $8 cost. So we're making a $3 profit, basically, on all of the shares that we're selling, right? So once again, let me show you how this works, right? We bought these shares at $8 a piece. How many did we have? 75,000. Then we turned around and sold some of them. We sold 54,000 shares at a cost of $11 a piece. Okay, so you have to do the math there. Okay, let's do the math here. So let's take 54,000 times 11. Okay, 54,000 times 11 is the cash that came in. Okay, that's the cash that came in. That's the cash that we sold them for. All right, and then, so let's put the cash in. Here comes cash. It is 594,000. Okay, 594,000. Okay, this is buying the shares at 8. This is selling some of the shares at 11. So when we sell some, we got to take them out of here. Okay, so we actually need to take out 54,000 shares so that how many shares are left? There's 21,000 shares left. We have to take 54,000 times the $8 cost, because that amount will come out of the treasury stock, and then we'll record the profit. So, okay, here comes cash, right? Here comes cash for selling those 54,000 at $11 a piece. So I got 594,000 as my debit. Okay, now I'm going to remove 54,000 shares, but I can only remove them from that treasury stock at $8 a piece. So we're going to go 54,000 times 8. Okay, that's going to be $432. 432,000 is going to come out of treasury stock, and the rest, that profit, right? So the profit we made is the 54,000 shares that we sold times 3. Yep, times 3. So we made a nice little profit of 162,000. Okay, so here's what we got: a debit to cash. We're getting rid of 54,000 shares out of the treasury stock, but we can only use its cost. Okay, the cost was $8 a piece. Okay, so let's put that in. And then the extra is the 162,000 that's going in an account called paid in capital from sale of treasury stock. That's how they record their profit. Okay, that's how they record the profit. Let's see if we're right. Okay, the third selling of our shares is gonna happen on November 14th. Okay, so once again, let me give you the dates of this stuff. May 27th of this year is when we bought all those shares. Okay, then we sold 54,000 of them on August 3rd. And then we sold some more. Oh, we're selling the remaining shares. We got 21,000 left to sell. Okay, so this is going to be November 14th. November 14th. We're going to sell the remaining 21,000 shares, but we're going to sell them for less than we bought them for. What? Yep. I guess our shares aren't doing too good. Okay, we're selling them for $6 a share. Okay, so we're gonna have a little loss on these, right? It's a good thing we should have sold them all August 3rd, right? But we don't have a crystal ball, so we don't know what's gonna happen. So 21,000 times 6 is gonna get you how much cash is coming in. And if you need to leave, that's okay. So 21,000 times 6 means we got cash coming in for 126,000 from that last sale. So cash coming in. We'll see you in 2 weeks. Have a happy Thanksgiving. You betcha. Thanks for coming in. And then we're going to back out the remaining shares, right? But we got to back it out at its cost. So that's going to be the 21,000 times, 21,000 shares times 8. Okay, so let's do math here. Equals 21,000 times 8. So that's 168,000 as a credit, right? I'm going to put that credit down here, 168,000 coming out of treasury stock. What we're going to do is we're going to show a loss. Yep. How much did we lose? $2, $2 a share, right? Because we bought them for 8 and we sold them for 6. So we're going to put that loss in the same account where we put the profit. Okay. And that's what happens when you buy shares of your own stock. There's always a chance that the value can go up, but there's always a chance that the value can go down. So this is going to be a debit to the sale of treasury stock. And so that's going to go up and down based on whether we have a profit or a loss. By the way, that should be paid in capital. So that extra is going to actually go in here. So we didn't make as much as we thought we were going to. Okay. So those two offset each other. Now, if you guys are finished and if you want to leave, you can. I'm going to go ahead and finish for the recording. Okay. So happy Thanksgiving.
Thank you very much.
You're very welcome. I'm going to show how stockholders' equity gets reported. Okay. Gets reported. I've got a nice example here. Here's paid in capital. Sometimes stockholders call it contributed capital. Paid in capital is all about selling stock, right? Anytime you see the words paid in capital in an account, they're going to get put in that category. So we're going to put this in. Okay.
Thank you.
You bet. So stockholders' equity, the paid in capital part, we're going to report to common stock. Or are there's no preferred up here. Preferred will get listed. If you guys got to go off of Zoom, that's okay. I'm going to keep going until I'm finished with this video. Bye-bye, Riley. Have a good Thanksgiving. Okay, we'll see you back here in 2 weeks. All right. Okay, so we're going to put the common stock. We don't have any preferred. Don't list anything you don't have. We got 2,240,000 that goes here. And we're going to put its paid in capital in excess of par common stock. It's going to go with it. It's always going to go with it. Okay. It's like peanut butter and jelly. So we got 504,000 here. Now we just add those two together. Okay, so, I'm gonna do a little adding here on the side. Just so I get my numbers, 2,240,000 plus 504,000. That gives us, paid in capital, total for common stock, right? Just common stock alone is 2,744,000. Okay, do we have any other accounts that say paid in capital? Yes, we do. We have one from sale of treasury stock. Yep, so we had a profit of having treasury stock, and we were able to sell our treasury stock to help out our capital, and it's 112,000, right? So then you add those two together to get your total paid in capital. So I'm gonna put 112,000 here, and I'm gonna add the two last lines together so that I know what my total paid in capital is, 2,856,000. Now we're ready for retained earnings. Retained earnings is the second piece. Now, once again, paid in capital is all of this up here. Just so happens, if we would have had preferred stock, we would have had another two lines first. Okay, so now retained earnings, they have given that to us, I believe. Retained earnings is 1,030,000. Okay, and then we'll have a total, so we're gonna add that together. Now, the last thing that gets reported on the stockholders' equity statement, let me add these two together, is if you still have treasury stock. You still have treasury stock. So yes, we do in this problem. So 3,886,000. So we have to subtract the amount of treasury stock, and it's 54,000. I'm going to put that in as a negative here. I don't think they're telling us whether to put it in, but I'm going to. You have to subtract any amount that's still in treasury stock, still in that account, because you can't include your own stock as extra equity. You can't do that. Okay, so if you own treasury stock, it has to come out of equity before you report your total equity. So total equity, if I've calculated things right, is 3,832,000. 3,832,000. So this was kind of a test to see if you could follow an example of how to put something in to a stockholder's equity statement. Remember, this is the bottom of the balance sheet, right? The bottom of the balance sheet. Okay, we got two more. Okay, we're going to put in some more information now. This is the statement of stockholders' equity. This is how the balance sheet part of stockholders' equity gets reported, but this is the true statement of stockholders' equity. I don't know if you remember, but we did some of these when we first started the semester. So we're going to start with the balances on October 1st, and we're going to end with the balances on October 31st. We're going to follow along. Now, our example doesn't have preferred, it just has common, okay? So it's going to say this is Nordic Cruises. They're talking about the month of October. So starting in the month of October, they had 175,000 in common stock. Began the month of. The additional paid in capital, all right, is 3,575,000. Okay, retained earnings is 12,200,000. 12,200,000. Okay, I need a total to add across there. Okay, so I'm gonna have to put this in. Okay, let me put this in. Okay, so let me add these together. All right, so 175,000 plus 3,575,000 plus 12,200,000 is a total of 15,950,000. All right, let's see if we've gotten things started off okay. Looks like we have. Okay, so what are some things that can happen when we can have net income, we can issue additional common stock. Okay, it looks like during October, Nordic issued for cash 30,000 shares of common stock with a stated value of $1 at a $12 per share price. So I'm going to put this in down here. So we sold, right? How many extra shares for the year? 30,000 extra shares at a cost of $12 each. Okay, so the additional stock, the stated value is $1. So the excess is $11, right? Because 11 plus 1 is 12. So this is the excess. So we've got 30,000 times 1. And then the excess, nope, 30,000 times 1. Yes. And then the excess is the 30,000 shares times stated value and par value mean the same thing. Stated value and par value mean the same thing. So 30,000 shares times an excess of $11, right? We sold them for 12. $1 of it is the stated value. The other 11 is the excess. So we've got 30,000 shares with an excess of $11 each. Okay, 30,000 times 11, not 111. There we go. That's more like it. So let's do additional common stock. Okay, the additional is 30,000 and the extra is 330,000. So we just go across and we add that together. So it's 360,000 additional stock. Stock doesn't go into retained earnings. It does not. Okay, so one more time, common stock, I'm going to show you this. Common stock had a balance of 175,000. We added 30,000 to it with the stated value of $1 times the 30,000 shares. We sold that additional stock. The paid in capital in excess of par is 3,575,000. That additional 30 shares at the excess over par is $11. Okay, so there's where the 330,000 goes in. 330,000. So now we have an ending balance there. Okay, so I'm going to put the ending balances down below here because net income and dividends will not mess with the first two columns. So 3,905,000. All right, so our net income. Okay, let's show our net income. It's not going to affect common or paid in capital common, but it will affect retained earnings. It makes retained earnings go up 2,400,000. So we just need to put that over here, 2,400,000. And I think I've got retained earnings somewhere here, maybe. Okay, retained earnings. I'll add it together here in a minute. And then dividends, cash dividends declared. Okay, they're declared. So cash dividends does not affect common stock. does not affect the paid in capital, but it comes out of, and it should say declared and paid. Declared and paid would be nice. Okay, so, yep. And now we need a retained earnings total. Now I didn't make a T account for that, but that's okay. I'll just add it together here real quick. So we've got retained earnings starting with 12,200,000. Then we added 2,400,000, and we're taking out 425,000. Okay, so adding those up is 14,175,000. Okay, now we need to add this way or this way. Doesn't matter. It's supposed to be the same. Okay, so let's go ahead and add up. I'll have a retained earnings here. So, oh, and by the way, this is total equity. So you do add common stock. So total equity. This is the total retained earnings. Total retained earnings. Okay. And now we're going to do the total equity. Equity. So we're going to take the total retained earnings plus the common stock of 205 plus the paid in capital in excess of par of 3,905,000. And we've got 18,285,000. So there you go. There you go. There is calculating a statement of stockholders' equity. And now we have one more problem to do. One more problem to do. This is always usually a ratio of some kind of measurement. We're going to be doing what's called earnings per share. It's also known as EPS. Here's the formula. The formula is you take net income, you subtract any preferred dividends as the numerator, and then the denominator is the average number of common shares outstanding. All right, we've got year 5, year 6. Let's put in our net income for both. 1,133,600 is year 5. 1,771,100 is net income. The preferred dividends are the same. Okay. The average outstanding shares, they're giving those to us, 81,000 for year 6. And 57,000 for year 5. Okay, now what we do is we add these two together and divide by this. So this is the numerator up here when you add it together and divided by this. So if you add these together, that's the numerator, and divide by the average outstanding shares, you're looking at for year 6 earnings per share of 1880. Okay, 1880 is the value. We do that same calculation. Uh-oh, hang on. Look, they have flip-flopped these. Ah, I knew it. I knew. Okay, so let's put it in. Year 5 is 1880. You can tell that I've had that happen to me because I was getting pretty concerned. All right. So then the same thing for year 6. We take net income, we subtract, we don't add, we take net income, we subtract the preferred dividends and divide by the average outstanding shares. Okay. So it looks like our earnings per share are going up from year 5 to year 6 with you could have really spent a lot of time. We wouldn't have caught that. So Is it favorable or unfavorable? Well, the more there is earnings per share, the better. Yep, there it is. So, okay, guys, that's it for chapter 12's intro problems. Please stand by for some of the coursework. I've only put 2 problems in for each chapter 11 and 12 for the coursework. So if you'll please follow along, we'll get this done and we'll get this semester wrapped up, for heaven's sakes. So, okay, I'm going to say goodbye so I can convert my Zoom meeting and post it in the module. So I will see you later. Goodbye, Rebecca. I don't know if you're still hanging in there with me, but thanks for doing so. Okay, we're going to end the meeting, the Zoom meeting, so I can post the video in Cengage.